mining investors, which are retail American centric, whereas the metal investors that are buying, they're from the Indias, from the Chinas, from the Russias. And so they're different set of buyers. So
Right.
eventually will converge when mining companies start delivering profit and dividends. So that will have to call for a $2,800 gold and around, $40, $50 silver. That's when the buyer, if you want to see, you know what, John, where am I going to see First Majestic go back to 27, right? You're going to see $44, $50 silver. And when is the Barracks and Newmont's going to challenge this whole time high, you're going to see $2,800 gold.
Good morning, John. How are you? Or I should say good afternoon to you where you're at. How are you?
Doing fine. How are you?
Doing well. As I was saying, just off camera, I had you on about a week ago and you talked about how bonds will start. You're very negative on bonds and the bond yields will start exploding. And obviously that means the bond price is going down. And that's exactly what's happening. Talk to me about that. What's going on? And let's start working that out.
We haven't seen nothing yet. When I came on the show, I said we've been waiting for the moment. It's a high confidence trade. The 10-year was about 109.5, and now it is just under 108. So it's corrected about 2%. But yield-wise, 10-year was sitting on 4.4, 4.3, which is a 200-day, strong 200-day support. Now that just in a week, it's gone from 4.3 to about 4.7. So that is a sizable move in the bond, in the yield, in the world with the bond, in the bond yield world. It hasn't broken down yet to the lows. That was, I recalled about 8 months ago. So and the 2-year are still just an inch below 5%, which is a very, very strong resistance level. It's a matter of time. And usually when things move, they can move quite quickly. And I would not be surprised if the 2-year takes out 5% and the 10-year is going to zoom past 5%, and the inverted yield curve will resume normalcy, because in an inflationary environment, Andy, people would demand higher interest to park their money longer term. So this anomaly will have to be resolved either through lowering of through either lower short-term interest rate or much higher long-term interest rates. And as you said, and my stance on that, which is the latter. Soon enough, I don't think there's really any discussion about. Well, there's still a muted discussion, but it's almost the interest rate cut crowds are just giving up hope, and I don't see a rate cut now on the horizon. If anything, you'll be looking at a rate hike probably right after the election. And it appears that Jay Powell is sort of losing confidence with the crowd, and I would not be surprised, regardless of which president that gets elected, that Jay's days are somewhat numbered. And the prime candidate is this Neil Kalikari guy out of Minnesota, Fed. That's just that's another bit of a crony. I remember 3 years ago, they said the interest rate is still staying definitely low. We can have a ban that interest rate inflation can tip above slight bit. It's okay. It's transitory. But now he's the one that's saying, "Oh, we're going to see months of positive low inflation data before I contemplate an interest rate cut." So he's probably the prime candidate, because he does what people tell him. He does what the boss tells him to say and to do. So that's my prognosis.
Yeah. So the yield curve flattening or going back to normal, that's interesting to me because we both know that an inverted yield curve signals recession. When it starts to flatten out to go back to normal, what exactly does that mean? Does that mean that a recession is imminent, or does that mean we're in recession and going to be coming out? Talk to me about that.
I don't know who conjured up the idea that an inverted yield curve signals recession. I don't think there's empiric evidence that points to that. As I said, what we've been told in the last 40 years is things have changed. Has been the paradox is broken. You had a declining interest rate from 1980 up to 2020. So that is a 20-year bull market on the treasury, and there's a 40-year bear market on interest rates. And now the interest rates is heading up on both the short and the long. And I don't read too much into the recession. Like, what is the definition of recession? Okay, it's a GDP. How do you calculate consecutive negative growth of GDP? GDP in itself has all the different elements. This is economics, and I think I think it was you I talked to on the show that I think by many aspects of it, the economy could be in recession. And let's talk about the Chinese calculation of GDP. That's entirely different matter. So I don't read too much about whether we're in recession or not in recession, but rather what you look at is the equity prices, interest rates, where the dollar is.
Got it. Okay. So then with bond yields climbing, that's not good for stocks. Talk to me about that.
You're right that bonds and stocks are competing for your capital. So in a normal scenario, which we're not in, in that, yes, if the dollar is finite, it has to choose between bonds and stocks, and if the risk-free rate is 5%, then stocks have to offer dividends in excess of 5% in order to attract investors. When I was talking about on your show last time, there is a caveat, which is there are some people that don't play by the rules. And what I mean by that is they control the printing press. So either you say that well, in a gentler way, you can say they quote unquote borrow money, which they basically it's a journal entry with the asset and liabilities. So they take money and they're buying S&P in hundreds of billions of dollars on a daily basis, either through the disguise of ETFs from the Vanguards and the BlackRocks and State Street, or through what they call the plunge protection team, which has been talked about for a long time. And these are not small fry quantities. You're talking hundreds of billions of dollars, tens of billions, hundreds of billions on a daily basis, just through the volume that I track through sort of the futures that are being traded on critical support level, right? It just, or that's a general way to put it, kosher way to put it. And on a more blatant way to put it, they literally just print and they're buying. And so, this is not different from what's happening in Turkey. Like when Erdogan was elected president about 6-7 years ago, the Turkish lira has gone from I believe it's around €5, €10 at the time, and now it's 30 lira. And people say, well, we struggle to control inflation. We should raise interest rates to dampen inflation, and inflation is running crazy. Inflation is the result of money printing. So in the case of Turkey, is they are literally printing lira to the politicians and the back door. They're just printing with abandon and buying assets, right? Buying apartments in New York, buying precious stones, buying precious metal, buying real estate, buying stocks, buying airplane. And all these things are denominated in US dollars. And that's why you're seeing the devaluation of the lira, because that's the only thing they can print. So the guys are controlling the printing price. Well, they control the US dollar. They're raising interest rates, and then they're jacking up the dollar because it's a below discussion, Andy, but they are also controlling, the ones controlling the Fed are controlling the BOJs, ECBs, and BOCs. So they are, in my view, the Bank of Canada, Bank of Japan, and not so much Bank of Japan, Bank of Canada and ECB and BOE are literally printing their national currencies to buy the dollar, to prop up the dollar. and the Fed is raising interest rates so that they can have a stronger dollar as a backdrop while they're printing to buy S&P 500. We'll talk about the King analogy, which you guys can refer to the last interview. So the end result is these guys are not playing by the book, meaning that if the interest rate's at 5% and the Nasdaq and S&P are breaking an all-time high, 10% is not going to deter them from continuing to buy because they don't play by the rules, right?
Right.
And it's okay, you're going to pay 10% interest a year on your $3 trillion of debt. Okay, it's fine. Let's just borrow another $200 billion to pay. So this idea of debt implosion, debt coming home to roost, it's only applicable to the
If you play by the
little
rules.
guys.
Yeah.
Yeah, the little
Yeah.
guys. And that's why I'm not bearish of the equity market. You might see engineered correction just to cool down the temperature, but the direction of the equity is up. How do I know that? Every time I short it, in practicality, every time I short, I lose money. So
Yeah.
if something is afoot, I cannot explain why. And that's the only reason I can come with. Having stocks go up in a rising interest rate environment, in tepid economic growth, in times of war, and in divisions of the two largest economies in the world, and Apple is still trading, trillions of dollars, and just that's the only conclusion I can come. These people that are buying are not buying to make money; they're buying for control and for influence.
Yeah. I'm very sympathetic to that view. And the reason, especially right now, we got an election coming up, and it's just hard for me to see the stock market tank, the S&P tank with an election coming up. But I guess what's really interesting is this whole dynamic with not only stocks, but with the dollar and the bond market, which you've alluded to. I had Simon Hunt. I don't know if you're familiar with him and his work on about two weeks ago. And he's talking similar to what you're talking about, but really the question is, and he said, this is the question: do they pick the dollar or do they pick the bond market on what to save? And they can't pick both. And it looks like
Meaning, what does it mean? Pick.
well, okay, so you can't how are you going to prop up the bond market and how are you going to prop up the dollar at the same time? I mean, because one, you'd have to, it's either or, right? Because you'd be printing money to buy bonds or stocks. So the dollar would decrease, right? Or you're going to jack up interest rates to attract either domestic or foreign buyers of US dollars because the interest rate is high. So which one are you going to pick? And
Well,
so
certainly it's easier. There's a loose correlation, but it's a correlation between the dollar and the yields will not go negative because the higher, because the yields are high. Certainly a lot easier to prop up the dollar if the interest rates are high because
right,
it's incentive to buy.
right,
Couple of things. The politics are so polarized in the United States
yeah,
that people who don't like the republic, they will vote for Democrats even if they're hungry going on the street. And
right,
so it the sort of um the character sort of the narrative is that politicians, like I said, the politics is so polarized that they can still get away with 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 uh with just talking points rather than some concrete actions to prop up the economy.
yeah,
Certainly on the dollar and the bonds, and that's one conversation I actually wrote here, is I want to share with you how the market works. Let's talk the dollar. The dollar index is very, very easy to work with because it's synthetic. When you talk about the dollar index, it's a basket of currencies. And as I mentioned to you, the guys behind the dollar is the same that's driving all the central banks. So to prop up the dollars is very simple. Just have the Fed come in talking about potentially up, that inflation are persisting and the chance of rates cutting is being shelved. Create that expectation there may be rate hikes to corral the people into the dollar rally, and then they just need to nudge through the futures market in ask all the other central banks to print their national currencies to buy the dollar. That's all you need to do on a temporary basis and on a long-term basis. And secondly, on the yield, so how do you calibrate the treasury market by the managers? That's even easier. If you want the yield to go up, you can do what they call the quantitative easing, which is what the Fed has been doing from 2010 to 2020. Like
Right.
if if the government is running a deficit and it's nobody bidding the bonds, which means the yield need to go up, the bond prices need to go lower, and then so the guys which make the bond cheaper, right, to entice investors. And if the government's agenda at that time is to continue the debt binge to try to maximize the opioid opioid dosage to try to recoup them debt, then they will just monetize the debt the Fed can buy. So the Fed has got hundreds of billions, maybe trillions. So that's how you prop up the treasury. And if they want to smash the treasury, you can drain liquidity two ways. The opposite. So the government, it's easy. The government just do deficit spending, right? Continue
Yeah.
to issue bonds to drain liquidity from the market. When I say drain liquidity, is once your money, your dollars, your money, your deposit is exchanged for bonds, then your money is parked. So that is liquidity taken out of the market. So the government, just as yesterday, the government had a very low uh, interest in 5-year bond treasury auction. And that's what caused the treasury prices to go down, interest rate to spike. Again, it's engineered, Andy, because if the Fed, if the government wanted low interest rates and low interest rate to stimulate the economy, they could have easily done that by calling the Fed to come in and monetize the debt
Right.
to put the easing. But as I mentioned, one more time, the era of low interest is over. It is one of the very few occasions where what the government wants, the manager wants, the action that the government wants, and the fundamentals of the market is aligned in the treasury, which is they want the treasury to go down. They want the interest to go up so that you could own nothing and be happy. And the Fed, if you to watch the language, is scaling back. They have all stopped in purchasing bonds. They're selling their bonds. They're
Right.
holding. So what's happening? What that means is the Fed is also helping the government in draining liquidity, draining the money, draining deposit from the market, from the ordinary people. Because when the Fed is selling the bonds, you end up with holding the paper, right? And your money is gone to the Fed. The Fed will just disappear, will just be buried. That's just the asset of the Fed. So as I mentioned to you, the difference between lowering precious metals and shorting treasury, fundamentally, you're on the right track because the treasury is worth zero at the end of the day. They're not worth anything. And similarly, the metals should be a lot higher. But the difference I favor treasury over the metals is the metals, the UN cartels are the opposite ends, right? The cartel want the prices go down. Whereas in treasury now, the cartels and the fundamental both will dictate lower interest, a higher interest and lower treasury. And that's what I'm saying, that the yield's going to go a lot higher and treasury hasn't crashed yet. When the 2-year, if you try to pick over 5%, that's when hell going to break loose. You're just going to see that 10-year zoom past 5% to 6%. So that will represent probably a 10 to 20% correction in the yields. And that will be a big, big deal.
That's
That's one
a big.
last, really,
Yep.
really funny is I don't watch a lot of television anymore because that just crowd your judgment, right? But you're still seeing the economists. They're the worst bunch, right? They're reading. They're just, oh, we don't know. We have to wait until the next time the inflation number come out to see whether it's going to be a rate cut or rate hike or economy. There may be recession, maybe not. This is just storytelling. And there's been plenty of times the Fed come in, even the CPI number, right? Like they cannot control it day to day, but they would revise upward or downward. So all this is hogwash. And you have the guys that used to listen to as gospel, the like of Double Line Capital, Richard Gunlock, Jeffrey Gunlock, right? He's talking about all this fancy chartings and numbers and leading and lagging indicators. He's saying there's going to be 2 rate cuts this year on CNBC. Just deadly wrong. And as I said, I'm very clear, a very, very strong conviction. You were saying.
Yeah. Well, okay. So you alluded to that, to what I'm about to ask is what does this mean for my listeners? What does this mean for the metals market then? how does this play out? And also with the metal stocks, because it seems like in a typical, well, I don't want to say it seems typically this would be negative for metals, but yet metals they've been extremely strong here really since last October. And I would even argue much longer since, I mean, gold probably the last few years. And now it looks like the gold and silver equities have really broken out since February. So, yeah, what does this mean for all of that?
There's a short-term and long-term answer. Um,
Give me both.
the I think first of all, the yields is going up. The managers want the dollar to go up. And the reason is it's much easier to deal with white currency than several currencies.
Right.
But the Aussie dollar and Canadian dollar, which are commodity currencies, and also BOE, which has at least some resemblance of some governance and normalcy. So there's inclination for the dollar to head down, in fact. But so the managers try to prop up the dollar. And that's why I actually favor shorting yields rather than lowering the dollar or shorting the other currencies. Now, on the metals are very underpriced. And that's why you're not seeing the mining companies making money. The likes of silver mining companies still, even though they might gone up double from their low from the start of the year, but they're still 70% from the high. And we're entering, so I think the short answer in the medium term is we're entering into a traditionally low seasonality, and that the managers are determined to rally the dollar and interest is going to go higher. So these are the headwinds for gold and silver in the next 3 to 6 months. Uh, and then same with we also talked about on your show why the mining shares are not doing are not going crazy. Metals are all time high, and yet mining shares are still 40% of what they were, 80% of what they were. As I mentioned to you, it's a depleting business. The reserves that were there 15 years ago, they're not there anymore. The mining equities are managed and are manipulated shorter, just like the metals, because they don't want people to see some peculiarities of why the shares going up, right? And the third is the metal prices are just not the mining companies are not delivering dividends. And the third is that the metal investors are different from the mining investors, which are retail American centric, whereas the metal investors that are buying, they're from the Indias, from the Chinas, from the Russias. And so they're different set of buyers. So
Right.
eventually will converge when mining companies start delivering profit and dividends. So that will have to call for $2,800 gold and around, $40, $50 silver. That's when the buyer, if you want to see, you know what, John, where am I going to see First Majestic go back to 27, right? You're going to see $44, $50 silver. And when is the Barracks and Newmont's going to challenge this all-time high, you're going to see $2,800 gold. In the short term, I am a
Got it.
little bit different. If you have a time horizon of 3 to 5 years, I think it's still a great time to buy the metals and the shares. But you have to be able to withstand correction for gold is around 2050. That's the 200-day moving average, and maybe potentially briefly below that. And the 50-day moving average is around 2330, which is what we are seeing right now. So
Mhm.
it's sitting there on the edge, maybe falling over, and if it does, it could go back to 2050 in a hurry. On
Okay.
silver, the 200-day moving average is around 20. I recall it's around 25 or 24, 25. And the 200-day is, don't quote me on it. I have to look up. I think it's around 23. So the downside for silver is a little more. It's for gold, technically speaking. Um, but then silver, it's got a 30-day critical used to be critical resistant, which is not a support of $30, right? But so John
Yeah.
is still out. I would not be doubling down and taking out leverage to buy right now, because it warrants a bit of caution. I would rather buy silver. Let's talk silver for a minute. I would rather buy silver on breakout of 33 than to be buying here at 31, because if you go down below 30, you can see 26 in a hurry in like 2 or 3 days.
Yeah.
The challenge in trading silver, as I am trading, is very, very difficult, because when silver breaks out, you got to be on the pulse, because it could go $4 or $5 in like 2 days, right? But
But
then you can also do a fake breakout. Sometimes the manager will purposely uh, stage a fake breakout by actually buying silver to create that breakout to try to maximize the the squeeze, and then they would then sell down if there's no follow through. So it's a very, very difficult thing to time breakout. unfortunately.
Yeah.
And everybody's risk tolerance at that time horizon is very, very different too. Here's the one I would say. If gold managed to gold that's break down below 50-day moving average of 2330 and head down to 200-day of 2050, 2100, I would embrace gold at 2100 with two hands, with my arms. I would just like I did with treasury. We're a very, very short treasury because
Uh-huh.
technically on the 200-day moving average on the bull market. And then with silver, as I said, I will also be embracing with two arms. If silver were to ever go back in $25 to $24 range, which is possible, I would assign it be a maybe a 30% probability. And then another 30% probability hovering around these levels, around 30 to 28. $30 is the resistance, but they try to spike it down just to induce additional selling, and it's gonna make spike up. Very, very difficult market to trade for silver.
Sure.
My takeaway is I will not plunge all
Yeah.
for the technical traders. For the fundamental traders with 3 to 5 year horizon is still a great buying because gold is only 10-15% from breakout level and silver is broken out at 30 and yet to be seen what's going to happen. So I think we'll be quite happy with the 2 year time horizon. Besides that, real estate market, I would deleverage. I would go. I think the 7% yield. I think the mortgage right now is probably 7.5 or 30 year. It's still a good place to. When I first bought my home in 1994, it was 8%, right? And now it's going back to
Right.
that. So it's still a good time to. I would not sell my primary home, thinking it's doom and glue and bury me, in my bunkers. I don't see it that way. Um, but I would deleverage like I am right now. I used to own over a dozen real estate. So I'm selling down right now. Um, I person population is decreasing, and the birth rate is dropping, and the mobility of money in speculating by investors globally is not as big appetite. Interest rates are rising, so I just don't see real estate is a good place to be. Rather, I want physicals. That's another thing I recommend. You want physicals because you never know how digital currency is going to pan out, and you don't want to be imprisoned in the voucher system.
Yeah. No, I would agree with all that. In fact, I would not be. It's funny because my family wanted to upgrade our living quarters, and our mortgage would double, and just because of where interest rates are. 'Cause my current home interest rate's about 3%, and
Wow.
yeah, it just doesn't make any sense. We'll just stick it out in a small house. So,
Yeah.
but interesting too. If silver were to get to 24, $25 range and gold to hit about 2 grand, 2,100, 2 grand, I would mortgage that house to buy more. So,
Yes. I mean, you're a young kid, right? And I'm 50.
well, I'm your age. I'm your age and still do it. So,
It's just sometimes it's not about a lot of money. It's the stress level, doing
yeah,
what you're passionate about, and
that's true.
I think there's always some point of diminishing return
Yeah,
on trying to squeeze the extra penny to by doing a lot more work, right? And so
yeah.
it's
Well, if you were to do that, you'd look like me. You'd lose all your hair. Well, let's end on that, John. I want to thank you so much for coming on the fly. I really do appreciate that. And I'd love to have you on again as things play out. Shoot me an email or I'll shoot you an email. John, I need you on and we'll talk.
buy some physicals. And for the first time in 10 years, I started buying physical in 2005. I reloaded in 2015 and I'm buying physicals again, not because I want to make money, but I can stash it away. Um, there are times where they were shutting out the network ATM in Las Vegas and they're shutting out electricity in Pakistan. You can go like, who knows how the scenario is going to pan out, right? You want some physicals.
Yeah.
Um, you this is a very fragile world. Uh, if your phone doesn't work, if your internet doesn't work, if the bank doesn't work, look, if an airplane can disappear in the middle of nowhere,
Right.
like you're like certainly banks can say your money is like
Yeah.
your banks are not working. It's not. It's not just some black swan event. You got to
Yeah.
prepare for that. And
Yeah.
so buy some
Yeah.
physical and then not to speculate and make money, just so you can sleep well. I think
Yeah.
that is something that I've adhered for the last 20 years. I've never regretted it. I am not going to say, you know what, fuck, like my condo in Vancouver has gone up 3 times in price. but yeah, my metals are only double, right? I don't look at it that way at all. And
Yeah.
I live man, guys on physicals. And when you buy physicals, buy coins. Because with coins, you can not only coins, it's like analogy is it's like you're buying steel versus buying Rolex, right? It's not
Right.
a analogy, but when you buy numismatics, you're also getting that premium on top of the metals. So you're
Yeah.
going to see the spread continue to widen, especially now with the numismatics. American Eagles, Maple Leafs, Cougarans, Australian coins. I like the maples because they're 99% as opposed to Eagle, which is 95%.
Yeah.
Grab all you can before you can't do that anymore with the digital currency. Your currency is not good to buy it from the Kitcos. They're gonna
It's,
throttle it. Make it a lot easier for them to throttle it. So watch out for that.
yeah. Well, thank you so much, John. Appreciate you having on, and let's chat again.
Yes, I think we can coming soon. See ya.
Bye bye.